Hello, ladies and gentlemen. It's a forex that is Zambia's finest blaze $1 billion. So we've started learning price action, and now we need to go deeper with things. Now, ladies and gentlemen, that we have learned how to know whether something, whether the market is in an uptrend, downtrend, and all that. We've learned why we need to use patterns, what price action is all about. We're now going to learn about the candlesticks more in detail, right? So without wasting much of the time, let's get started. So candlesticks are very important when it comes to trading price action. So candlesticks may form differently. They have weird shapes, different shapes, various shapes. And of course, depending on how they form, they can actually tell us what is happening in the market. You remember the lesson of understanding buying and selling pressure? Yes, that is it. But here we won't be understanding selling and buying pressure, but we'll be understanding what certain candlesticks tell us when they form a certain way. So let's understand them. So candlesticks can be categorized in two. There are candlesticks that we can call reversal candlesticks, and there are those that we can call continuation candlesticks. Now, reversal candlesticks are candlesticks that when they appear at certain levels, they signify to you that the market will be reversing. So if the market was initially going up, it means the market might be changing direction and to start going down. These candlesticks are called reversal candlesticks. And of course, I'm going to discuss some of them. The first set of reversal candlesticks are called doji candlesticks. Now, it's a Japanese name, and usually they comprise of small bodies and then wicks. So there are four types of dojis that we're going to discuss, and here are they. Here they are. We have the doji star, the long leg doji, dragonfly doji, gravestone doji. Now remember, we are discussing the reversal candlesticks. So each doji signifies that price might be reversing at that particular zone, right? So for example, if price was initially going upwards and it reaches a point of resistance and it forms a doji candlestick, one of these doji candlesticks, it shows you that the price would now be reversing. So but how we take these candlesticks, ladies and gentlemen, we don't just trade them anyhow and anywhere. What we need to do now is that we need to be using these candlesticks in reversal areas. For example, at support levels, at resistance levels, supply and demand levels, all those areas. So all these are reversal. So the doji cross, this can be considered both bearish and bullish signal depending on where it forms. So like I said, if it forms at support, meaning it will be a bullish signal signifying that price will be going up, and if it forms at resistance, it will be a bearish signal signifying that price will be going down. So the doji star is a warning that the prior trend might be ending. Like I said, if price was going up and then it reaches a point of resistance and then you see a doji star or a doji cross, it means that that uptrend might be ending. You might be looking at, taking your profits and considering taking sales, right? So the star's small real body represents a stalemate in the tug of war between the bulls and the bears. Like I said, so we can consider them as an indecision candlestick. So you might not always know what can happen. So understand by stalemate, right? So in a strong uptrend, the bulls are in charge. With the emergence of a doji star after a long bullish candlestick in an uptrend, it is a signal of a shift from the buyers being in control to a deadlock between the buying and the selling forces. So this deadlock may have occurred either because of a diminution in the buying force or an increase in the selling force. Either way, the doji star tells us the prior uptrend power has weakened and the market is vulnerable to a setback. So at the end of the day, we're looking at it being a reversal, right? So we have the doji cross, we have the gravestone doji. This is considered as a bearish reversal when formed in an uptrend. So the gravestone doji, let's look at it once again. The gravestone doji is this one. So now we are saying it is considered as a reversal when formed in an uptrend. So if it forms in an uptrend or at resistance, then it shows you that price would be going down, right? As we can see, even when we go to selling and buying pressure, we can see that there is more selling pressure, right? So this one is considered a bearish reversal candlestick, and it needs to form at a resistance. This one is the opposite of this one. This one is supposed to be formed at support, and it's supposed to be a bullish reversal, right? Yeah, as you can see, the dragonfly doji is considered a bullish candlestick pattern when formed in a downtrend or support level, right? The long leg doji, this shows a period of indecision by bulls and bears depending on where it forms. So if it forms at resistance, it means, you know, it's supposed to be going down. If it forms a support, as usual, right? The shooting star. So this is one of the most reliable candlesticks, and obviously one of the most popular due to the fact that they are so easy to spot, one. And the shooting star is also a single candlestick pattern. When it forms at an uptrend or resistance level, then it is considered as a bearish reversal pattern. So let's look at it. This is what it looks like. What does this tell you about selling and buying pressure? It tells you there is more selling pressure. So we have to wait. When we see such a candlestick forming at resistance, then we can take a trade. You don't just take trades anyhow. You wait for it to reach a major zone, and then once you see such candlestick, then you can take a trade. For example, if it reaches a resistance zone, once you see such a candlestick, then you can take a sell trade. The hammer. The hammer is also very famous and popular. So when it forms in a downtrend or at support level, you should take note. This is a very high probability of a bullish reversal. So when it reaches at the support and then you see a hammer, it means price will be going up. So as you can see, what can we say about buying and selling pressure? We have more buying pressure. So this hammer needs to form at support for you to take a buy trade. The hanging man candlestick. Now, what happens if you see in an uptrend a candlestick that looks like a hammer? Now you are in an uptrend and then you see something that looks like a hammer, like this one. Now, what does it tell you? So this one is kind of crucial. So when you see it in an uptrend and it forms at resistance, it doesn't mean price will continue going up, but instead it shows that price should be going down. Right? Yes, that's the hanging man. So it's opposite to the hammer. This one needs to form at resistance, and then it confirms that price would be going down. Let's look at the spinning top. The spinning tops can be continuation candlesticks as well as reversal candlesticks pattern, right? This is what they look like. You see, more like the doji, right? But they are spinning tops. So depending on where it can form, it can either be a bullish reversal or a bearish reversal. If it forms at resistance, then it's a bearish reversal. If it forms at support, then it's a bullish reversal. If you see a bearish spinning top at support area or in a downtrend, this can be considered as a bullish reversal when the high of that bearish spinning top is broken to the upside. Now, similarly, when you see a bullish spinning top in a resistance, it's a sign that the uptrend might be ending and you might consider taking a sell, because it's usually both a reversal and a continuation. So as you can see, price was going up. It reaches at this particular point, it forms a spinning top, and then it goes down, you see. So it's showing us that it has reversed the trend. Now on the other hand, we can see price going down, and then we have a spinning top, and then price begins to go up. But what you need to do in order to use this ensure that they are forming at major levels. By major levels, it can be levels of supply and demand, levels of support and resistance, etc., etc. Right? That's the thing. Never should you just trade it anyhow and anywhere. That's not how things should be, ladies and gentlemen. Right? Yeah. So, well, let's continue and let's ensure that we finish up. Right? The railway track candlesticks. So if you've seen a rail line, usually those railway tracks usually cut and almost they look like the same. So this can be a bearish signal or a bullish signal depending on where they form. At the end of the day, they are reversal patterns. So when you see these two candlesticks, when you see the first one is bullish, the second one is bearish, at the level of resistance, it shows price will be going down. By this candle, of course, this is the one that confirms. So when you're at support, you see a bearish and then followed by a bullish. They are of the same size and all that. It signifies that price will be going up. Remember, you only use these candlesticks in verified areas, right? So an engulfing candlestick pattern. This is very important, ladies and gentlemen. You need to understand. So if you did your biology in high school, ladies and gentlemen, and then you might remember that, is it the white blood cells, the red blood cells that engulf these, foreign substances in the body? So what is to engulf? It's more like to overshadow. So what this means is that you need to have two things. One thing is being overshadowed. So in this particular candlestick pattern, it involves two candlesticks. One is smaller than the other. The one that is bigger than the other is what we call the engulfing candlestick, right? So like this. This one is smaller than this one, and this one has completely overshadowed the smaller one. So this one becomes an engulfing candlestick. So if it forms at a support, it is a bullish engulfing candlestick. If it forms at resistance, it is a bearish engulfing candlestick. As you can see here, bearish engulfing candlestick, and price goes down. So look for these candlesticks in major areas like support and resistance areas. The Harami candlestick pattern, it's opposite of the engulfing pattern, in that we start, instead of starting with the smaller one, we start with the bigger one and then a smaller one follows. This shows that the market will be changing direction, right? Not very popular. Yeah. So of course that is another example. Let's look at the dark cloud cover. That's what it looks like. And of course, when you see it at the support, you know it's supposed to buy, or at resistance it's supposed to sell. Piercing line, this is what it looks like. Of course, these you can look at them. And then the morning star, very popular candlestick. So when you see it at this one, will only form at support. We'll only use it when it forms at support, right? This is a reversal pattern. It comprises of 3 candlesticks, 1, 2, 3, and they will look like this. This is what we call the morning star, and it is a bullish signal, right? So ensure you wait for it to form at support, and then after you see it, and then you can take a buy trade. The evening star is the opposite of the morning star, in that it has 3 candlesticks, yes, but the smaller one is on top. So this one, you need to wait for it to form at which level? At resistance. Once you see this at resistance, it is a confirmation for you to take a trade, a sell, and then see how it goes. So ladies and gentlemen, those are some of the candlesticks that you will experience while you trade. Ensure we don't trade candlesticks anyhow and from whatever point they form. We wait for them to form at significant points, and these stand as confluence for us to be able to take trades, right? So that's about candlesticks, ladies and gentlemen, and I'll see you on the next class.